Let's talk about it all on our closing bell exchange today. Joining us, we have Rob Morgan from V2V Associates, John Canale from LPL Financial, Tom Lydon from ETF Trends. Kate Warren joins us from Edward Jones today, and we have our own Rick Santelli. And Rick, I'm going to start with you. This whole issue of what the oil market and the decline has done to the debt market. Are you seeing any signs of strain in the debt market? The fear that maybe there might be defaults based on these junk bonds that were issued to help finance some of the drilling up in the Bakken area?
On a scale of 1 to 10, I think we're at a 2. It's an interesting topic. You can clearly see if you look at things like the Barclays junk bond index, that over the last month, junk bonds have widened out to treasuries by about 30 basis points, but still well contained under 500 basis points. If you look back at, how they were well over 12 or 1,300 basis points around the credit crisis, that puts it in perspective. Yeah. I think that no matter how you slice it, it's a good thing. Is it going to come at a cost? Absolutely.
You mean lower oil prices? Tearing
the fabric. Yeah, well, lower oil prices. I think from the Mideast perspective, that's more the conversation we hear down here. What's Saudi Arabia going to do? I don't know that they can compete against the wildcatting nature of fracking and its decentralized structure. I think it's the old school kind of oil services and, of course, the exploration and pumping like in the Middle East. That's going to have the roughest adjustment to this ultimately. Michelle did a great job yesterday, MCC, talking about it's not how much it costs to pull it out of the ground, it's what their budgets need to make everybody happy. And that's the equation we seem to be more interested down here in Chicago.
Right.
Kate, I know you're looking at the relationship between oil and the stock market. What's interesting to we really haven't seen in a while is that energy shares here are in the lead, yet the price of oil is falling.
Yes, and that disconnect is a bit surprising, but I think it says investors are, first of all, seeing opportunities in the stronger oil companies, probably on the expectation that the production cutbacks are by somebody else. And I think the second thing is that even with lower oil prices, many of those stocks are still, the companies are still making a lot of money. So more broadly, though, of course, it's other companies that do even better when oil prices drop because of stronger demand as well as lower costs.
We're showing Chevron and ExxonMobil and ConocoPhillips. Would you guys buy them at Edward Jones right now?
We have a hold on Exxon. We have a buy on Chevron. So the answer is yes. We would be buying those. We'd be buying Schlumberger. They're basically a series of oil companies that we think are attractive. Prices could certainly go lower, but those are the companies that have managed through much lower oil prices in the past and will do fine over time, even if short-term their profits take a hit.
So obviously, Rob, oil is a key theme in this market today, but we can't discount the economic data, which has been good. I know you were looking at today's construction spending numbers, just the latest in a series of better numbers out of the U.S. as we march on to Friday Jobs Day.
Yeah, and Sarah, if you look at also the vehicle sales numbers that just came out for November, those were the best November numbers really since 2003. So that basically is telling me that there is a strong consumer out there. Absolutely.
And does that continue? How much of the lower gasoline prices, Rob, do you think will contribute? I mean, are we oversimplifying to expect that lower gasoline will automatically mean a stronger consumer in the future?
No, Bill, I think there's definitely a correlation there that lower gas prices, basically it's like removing a tax from consumers. So yeah, I think there's definitely a correlation of some type there.
So I guess the question, John, is how much of this is already baked into the U.S. equity market with the Dow marching again to record highs? The good news on the consumer, the fact that actually it's not just you, Bill, but two very influential Fed speakers in the last 24 hours, Stan Fisher and Bill Dudley, also said oil prices at these levels should be very helpful for GDP.
Yeah, they'll add just by themselves. The drop in oil prices is going to add about somewhere between 0.5% and 1%. It's a plus for the consumer. But for the producers, it's probably a minus, and for net exports, it's a plus. So when you work it all out, it's between 0.5% and 1%. And of course, that puts more pressure on the Fed. It tightens up the economy. It's more job growth. It might get wages going, and that will concern the Fed. But I think just in perspective in oil prices, in 2010, before Arab Spring, oil averaged $80 a barrel. Since then, oil's averaged about 95. This year, oil's averaged 97. So actually, oil price this year has averaged higher than it has in the last 4 or 5 years. Question is where it's going.
Right.
There's no question that's going to hurt the producers. I think it's less of a help for the consumers than it has been in the past, but it's a bigger hurt for the producers, certainly.
Yeah, that average price for this year definitely front-loaded. We got a very different story this fourth quarter here. Tom Lydon, what about the stock market? It's typically strong in December, but are we beholden to this price of oil here? As long as it continues to trend lower, does that mean higher prices and vice versa?
Well, front-loading, I think, is the term, Bill, because we're seeing, as far as holiday shopping, a lot more people are spending money because, I think, of the benefits from lower oil prices, for sure. And one thing in particular, retail sales online have gone up tremendously. Estimated it was only going to be 1% higher from 13 to 14%. Early indication says 17%, and there are a couple ETFs specific to First Trust Internet Index and the PowerShares NASDAQ Index ETFs,
right,
both very heavily in those areas.
Yeah. Rob,